Hello friends, welcome back to another Alpha League session with me, AVB. Today, we've got the most awaited video of the month, of the last 2 months, since the inception of the channel, really. We're going to be diving deep into USN. And I think this is a really important video. That's why I took my time to prepare for it, because as you all know, there was a lot of hype leading up to the launch of USN. And just a few days after USN launched, USD collapsed. The collapse of UST, the Terra ecosystem with it, led to a market meltdown, and it's been some few days for everyone. So I think that this has really prompted everyone, including myself, to think deeply about what the fuck we're doing and whether this makes sense and whether perhaps we should take the foot off the accelerator. But after diving deep into the white paper and doing some thinking, I think I am ready to say that we took some marketing shortcuts in assimilating USN to UST. Understandably, people's heuristics, it makes sense to explain something new with something that already exists. However, I hope that this video clarifies that the things that are similar are the target market and how big it could be, like the use cases perhaps. However, at a technical level, it is a completely different ballgame. And in fact, in some ways, I'm actually grateful for the opportunity to dive deep and explain USN at a technical level in a way that perhaps people would not have cared before if USD was still around. So, a minute of silence for all the fallen soldiers, and let's use this opportunity to learn about some wicked that the USN team is delivering. So I'd like to start with noting that the introduction has two things that really got me going. And part of that, of course, is because I am Venezuelan, so I can read between the lines. It starts by highlighting the total addressable market, both looking at the entire monetary supply, which stands at 144 trillion, but most importantly, noting that the value of cryptocurrencies is increased from 0 to 2 trillion in over 2 years. It may be less now due to the bear market, but you can see the trend. And a very noteworthy statistic would be that in 2021 alone, the volume of stablecoin transactions exceeded $6 trillion. So to me, this really is an invitation to start thinking about how big could this get? What would have to be true for this trend to continue accelerating? That leads us to a closing statement and pretty strong foreshadowing that USN may be the solution. USN fully satisfy the key conditions for any stablecoin: fast transaction, low cost of trans-border payments, and outstanding stability. I would actually add that being built on the NEAR stack means that it has really good user experience. So we can start to see some early differences between being within the NEAR ecosystem and being in other ecosystems. You know, we can cherry pick different blockchains, different coins. There are pros and cons of each. I think that we can see that if USN is indeed stable and reliable, it opens up an entire new door. And I'd like to double click on the low cost of trans-border payments because, as we know, some of our most valuable people in the community, including a few NEAR core team members in Ukraine, myself from Venezuela, and very strong communities in Argentina, in Africa, and other developing countries, we can see the real need and the potential for stablecoins to disseminate wildly in these communities. So I really like that USN is being created as a real solution for real people with a real problem. And here we really do need to make a distinction between UST, because UST was both one of the only use cases of the entire Terra blockchain, but also Anchor and the very, very high interest rates were one of the main use cases for Terra. Like the vast majority of money was there. And we can see how once the trend started reverting, the ship collapsed very fast. So I really like that the introduction makes no promises and no mention of very high interest rates. And the reason why I keep going on about this is because I feel like we need to make the distinction between the customer segments. UST was mostly crypto people, which maybe didn't mind the friction of high transaction costs or less user friendliness. They just wanted the higher interest rates. And these are the people now that are judging USN. So for this video, we're really going to dial down the interest rate conversation, like despite the market conditions and bankruptcy looming near, no pun intended, This is really less about the short-term potential gain about interest rates and more about how stable is USN. Is it a solid base to build upon and something that we should trust our current capital in? So without further ado, let's jump right in. So we're going to have a really simple structure today. First, we're going to have a quick overview of the existing stablecoins. If you are a master of the stablecoins and all things crypto, feel free to jump ahead to the next stage. Then we're going to introduce USN and what really starts making it unique. As we go, I'm going to have the white paper on the left and then some questionable graphics with some outrageous GIFs on the right. So we're targeting for a wide audience today. Finally, I'm going to try to deconstruct with some examples why the stability mechanism is so smart. And we're going to look into some things such as a possible death spiral and why it is likely or unlikely to happen. Hint, I'm pretty impressed and I'm pretty happy to be sharing this information with you all because I think that you should also find it useful. So up until now, we've got 4 key types of stablecoins. The first one are stablecoins that are actually stable because they are actually backed by the US dollar. So this type of stablecoins is very simple. In theory, for every $1 that enters a real bank account somewhere, there is the digital equivalent issued. So in theory, if you hold a USDC or a USDT, you could go to the issuer, namely whoever issues USDC Circle or USDT, like literally who knows who issues that, and you could redeem one-to-one. USDC is very heavily regulated in the US. In New York, they've got trust funds set up. There's also PAX, which issues a Binance USD, also very heavily regulated in the US. USDT, there's been FUD since I've been around, like 2017 at least, and it has never been proven. Here, there's a couple of downsides, namely the risk of it being centralized. So you have to trust that the people managing the dollars are doing the right thing. And most importantly, there's a lot of friction in trying to issue or redeem. So what we see with these kind of coins is that there's normally a handful of whales. So you transfer $5 million in, you get 5 million USDT out, and then you do some market making on exchanges. I am yet to come across one person who has actually deposited dollars or redeemed dollars from one of these stablecoins. It can be done. It's just more time consuming. You got to do KYC. You got to have a bank account in the US. You got to pay for a wire transfer, which is $40. Your bank may charge you for receiving the money. There's a lot of friction involved. The next category is collateralized by crypto. So we've got coins such as DAI. DAI is pretty cool. I like DAI. The argument against DAI is often around capital efficiency. So because you need to have a pretty strong buffer to be able to liquidate people and maintain the peg. Normally, it has to be over collateralized by 200% or 180%, depending on the asset. So DAI is pretty good. DAI is still going strong. DAI has survived the test of time, but there are some scalability issues with DAI that may not quite make it that global currency. Then we've got semi-algorithmic. I love that the white paper literally says it's too complex. It hasn't really gained adoption. I agree. I don't think I know how Frax works. And I'm sure that if I look into it deeply, I can understand it, but it's probably a barrier to adoption if everyone needs to go through a master's class to be able to adopt a coin. And then finally, we've got the fully algorithmic coins that if you want the short version, they always implode, every single one of them. I am yet to come a fully algorithmic stablecoin that does not have the writing on the wall with USD, with an asterisk. I love how ominous the white paper is. They're like, yeah, unpredictable behavior of the system in case of Luna price drop. Sir, I think the behavior was somewhat predictable. So the system burned Luna on the way in, which gave people all sorts of like warm, fuzzy feeling, supply decreasing and USD demand increasing. The problem was that the system also had the ability to print an unlimited amount of Luna on the way out, which created a horrific death spiral. So, without getting too caught up on USD, because this video is about the new, novel, innovative, better, improved USN, let's dive right into the USN model. By the way, fun fact, I don't know how many of you know that USN actually stands for Unified Stable NEAR or something. And this is the official beginning of the outrageous gifts. I hope you enjoy them because they're going to keep coming. So there are two key things that we're going to dive into in more detail that make USN really quite unique. The first one is on-chain arbitrage through a smart contract, and the second one is a currency board principle with a reserve fund. If I had to translate this for normal people, what we're really looking at when we look at USN, and the easiest way that I would describe it to anyone is, it implements very simple, solid, time-tested economic principles, arbitrage, supply, demand, etc. Then it combines that with which would have simply renamed as closing the loop, which is the equivalent of on-chain arbitrage or smart contract. And here we have to understand that for the free markets to operate efficiently, you need to have all the participants with perfect access to information and the resources to execute on that information. So we can see how, especially in times of like crisis, quote unquote, you may not have all the information or you may just not be able to execute. So to give you the example, if USDT is trading at 80 cents, technically through the basic solid economic principles of arbitrage, you could buy USDT for 80 cents and then redeem it from the bank in the Bahamas for $1, and then you've made a 20% profit. But do we have the information that the bank in the Bahamas actually have the funds? And as we have already mentioned, the friction of having to go through the bank and how long it's going to take, the arbitrage opportunity may not be there anymore. What USN is doing is recognizing that even though the protocol is set up in a way that makes sense from an economic point of view, you still need someone to act upon those objective and rational economic principles. And if there's something that we've learned from humans, and especially humans, during economic upsides and downsides, there's very little rationality. So USN introduces the currency board principal reserve fund, whereby they automatically have funds to participate in the market and stabilize things in both directions. I'm going to dive deeper into this because it's actually done in a very smart way, even though it sounds horrific going in. And then finally, which is worth mentioning, and we will dive a little bit deeper towards the end, is a mad tech stack. And this is something that I'd love to be corrected if people in the comments have more information. But from what I can read, it seems like not many blockchains would be able to pull this level of sophistication, updating of parameters, fast transactions, microtransactions, low-cost transactions to make it financially viable. This really is a really novel offering that, even if it made sense for other people to do it before, may not have been possible. So on the left, we've got the basic model, and then on the right, we've got a real-time capture of my face when I saw it for the first time. So it's actually not that complicated, but I'll leave the one on the left for the big-brained people to stare at, and then I'm just going to try to unpack it in the easiest way that I can. There's only really a couple of things that we really have to understand to get the gist of what this on-chain arbitrage smart contract is about. The first one is the issuance and the buyback mechanism, namely this cheeky little box right here. So if we go to the source, to the issuing authority, the Decentral Bank swap directly, here you will always be able to issue USN or redeem NEAR at the real market price of NEAR. So even if USN is trading at a discount or a premium in the market, say refinance, you will always be able to issue or redeem at the real price here. Naturally, this creates some pretty obvious arbitrage opportunities, which we will dive into the flow in just 1 minute. So just bear in mind that the number one player is the Decentral Bank swap directly, or the source, the issuer. They will always issue USN or enable you to redeem USN at the real value in the market as determined by the Oracle. And the second thing, which is really important, is the USN Reserve Fund. So the USN Reserve Fund has been funded 2-to-1. So USN is over-collateralized with both NEAR and USDT. And because of a mechanism that we'll be diving into very shortly, this means, and the tagline is, that the Reserve Fund always has the ability to buy back every single USN in existence. So technically USN will always be collateralized because as it risks not being collateralized. It just keeps getting bought back by the reserve to maintain the peg. There's just a couple of requirements for this system to hold. The first one is that USN needs to be freely traded on exchanges. We know player one, which is the issuer or the Decentral Bank swap. They will always exchange at the real price. And then we've got players such as Ref Finance, where you can always trade at the market price. So this is the easiest and I know the kind of lamest visual representation that I can have. So let's call this the Big Bang, the inception. From day one, for purposes of the example, we have $100 worth of USN and the reserve, the Decentral Bank reserve, has $100 worth of NEAR and $100 worth of USDT. This is what we would call it being collateralized 2-to-1. There are two basic arbitrage scenarios. The first scenario is when the price of USN is trading below $1. And then the second scenario naturally would be when the price of USN is trading above $1. So in yet another marvelous graphic, which actually makes sense if you look into it closely, it's very simple. I tried to simplify a little bit here, but I may have actually made it worse. If USN is trading below $1, the play that would make the most sense would be you take one USDT and you exchange it for USN. Because USN is trading below $1, you're basically able to buy more of it, or you're basically buying $1 at a discount. So in this scenario, all you have to do is trade one USDT or any amount really for USN. You're buying USN at a discount. To do that, you would go to Ref Finance to the Stable Swap section. The Stable Swap section on USN actually has over $130 million worth of liquidity, and we can see the pool is pretty well balanced at the moment. All you have to do is just come here, buy USN at a discount, and remember you can always swap back your USN for the real value worth of NEAR. The second scenario would be the exact same, but the other way around. So let's say that USN is trading above $1. The play here would be to trade USN into USDT. So you're basically buying USDT at a discount, and then you can buy NEAR and redeem more USN. So I hope that this is making sense. I know that when maths enter the picture, it can get a little bit confusing, but overall, there should always be a trade within this love triangle for you to be able to make a profit and help stabilize the pools. Now, where things get really interesting and where some of you may have picked up the issue is, if everyday people are doing this kind of arbitrage, there is a risk that at some point, because you're trading against the reserve itself may become insolvent. And this is where the big brain comes in. And this is actually not said explicitly on the white paper, although maybe it is, but maybe it just took me long enough to understand it that I didn't quite realize that it's there. As we mentioned before, even though the arbitrage is really simple to do and anyone can come in and execute and profit from it. So let's introduce a new scenario. At inception, there was 100 USN, 100 NEAR, and 100 USDT. Easy does it. Anyone can understand that. Now, bull market is back on. Let's assume that the USN demand is growing a lot. Now we don't have 100. We've got 10,000. And we've got 10,000 because people have been issuing more and more USN with NEAR. And because the price of NEAR is going up, now this 10,000 NEAR, it's not 10,000. Now this is actually 20,000. There's a couple of elements here. The first one is that the currency board would technically automatically rebalance this position. What does this mean? That on the way up, the algorithm would automatically sell some of this NEAR for USDT to make sure that there is always enough USDT in the bank. This is where it starts getting really interesting. So a part of this currency board principle has been implemented in Hong Kong to make sure that the Hong Kong dollar has a 1-to-1 peg to the US dollar. And the paper starts getting really technical from here. They reference a paper here from the Journal of Empirical Finance. And the more you scroll, the more algorithms and crazy shit on the screen. But I think that the easiest way to explain this would be to address the elephant in the room. What happens if instead of a bull market and the price of the NEAR in reserves going up, we have a bear market and the price of NEAR in reserves is going down? So in this case, we've got 10,000 USN. Let's assume that we've got an equal amount of USDT, and the price of NEAR is now dropping. So instead of 10,000, which should be the target, now we have only 8,000. What happens in this case? People may start to panic. People may start trading USN for USDT. We've got a death spiral. But everything's going to die. Wait a minute. My brain almost exploded when I realized this. In this scenario, this is what they mean when the reserve can buy back the entire supply. Check this out. Their reserve, the Decentral Bank reserve, can take the USDT reserve, swap it for USN in the market, and once they have the USN, they redeem the USN for NEAR. But the NEAR is never exiting the reserve because it is being traded into the reserve again. So in this situation, you would be able to use $2,000 from the USDT reserve. So this would go down to 8,000. The USN supply would also go down to 8,000. But the key here thing is, and I don't know if I'm making too much of a deal and it's actually simpler than it is, but when they have the USN in their hands, they redeem it for NEAR and the NEAR stays within the Treasury. So you're basically decreasing the supply of USN to make sure that the mother reserve is always balanced. This is so smart and so cool. So I know the video is getting a little bit long, so I would strongly encourage everyone to dive into the white paper if you're interested into some more of the specifics. They've got a bit more detail here as to how the DAO can adjust the parameters, some of the basic functionality of this mechanism that I just explained in the simplest terms possible. One thing that I just really want to highlight, which I mentioned at the beginning of the video, is that given the decentralized nature and frequency of transactions in the cryptocurrency market, the central bank aims to implement the Treasury management strategy to perform frequent, dynamically configurable, nearly real-time small value transactions to avoid severe imbalances in the reserve fund. This here is key. A major role in keeping the USN stable and keep it fully backed in the desired target ratio is for the Treasury to be able to be managed automatically in the most efficient way possible. This would be in stark contrast with the management of some other blockchain foundations. They had to intervene manually. They had to intervene after 30% of the peg had been lost. They had to intervene in ways that are still lacking some transparency. And in general, we can see how it presents some issues. This is one of the things that just really got me going because the very frequent, dynamically configurable, nearly real-time small volume transactions, I'd like to see how many blockchains would be able to pull off that kind of strategy. The white paper also goes into the potential for a death spiral, but I think that once we understand the basic mechanism by which the Decentral Bank Reserve Treasury has both NEAR and USDT to be able to intervene in the market in any direction, and they do so frequently and automatically, a death spiral is increasingly less likely. What is really interesting about a death spiral is that, let's say that there is crazy panic in the market, crazy panic. And everyone, for whatever reason, starts swapping USN for USDT and USN is trading at a discount, even if USN gets to 80 cents. When it trades at 80 cents, it just makes it easier for the Reserve Bank to buy everything back for USDT and stabilize things over. So I think that maintaining this ratio is key. Awesome, friends. I hope that was able to clear up some of the FUD and provide a better understanding on the innovation that USN provides on how to maintain the peg. Let me know if you have any questions, if there's any potential scenario or flaw that I may have missed. And as always, thanks so much for your support. Let's keep building.